I was amazed to hear a representative for the car manufacturers recently say that the reason new car sales are at a 10-year high is because people are sick of getting low interest rates on their savings and are splashing out on motors instead. Now, far be it from me to criticise what people spend their money on. Roaring car sales signal consumer confidence, and that's good news for the economy and ultimately all of us. But financially, the idea of putting money into a car in the hope of a better return just doesn't stack up. Cars are notoriously the fastest depreciating asset there is. Drive your new car off the dealer's forecourt and you're thousands of pounds down by the time you reach the end of the road. So, where in the world are the racy, exciting places to put your money? Trouble is, the petrol heads have got a point. Savings rates are still awful. To get a real return on your money, you have to invest in stocks and shares. Now, stock markets are risky. They definitely have their downs as well as their ups. However, anyone who can fling thousands of pounds at a new car that will definitely lose their money can probably take a gamble on stocks and shares. Generally speaking, if you invest long enough in a stocks and shares ISA, you should make a return way ahead of cash. The problem is stock markets have done very well since the financial crisis. There is no more easy money to be made. Many investors are preoccupied with the slowdown in China and the outlook for the US. Overall, though, the global economy is picking up speed, and that's encouraging. But a lot of this is priced into stock markets, which, depending on where you look, are either expensive or fair value at best. There are no screaming buys. There are two possible responses to this. You could take more risk and invest in a really cheap market in the hope that in the long term it grows in value. Right now, there is no cheaper market than Russia. Emerging markets like Russia have been out of favour for a while. The standoff with the West over the Ukraine has sent Russia's stock market plunging this year. On whichever measure you use, Russia is cheap. Now might be a great time to invest in the country as it slowly develops into a modern economy. But it faces huge challenges and the risks are enormous. The chances are you probably don't want to entrust too much of your money to Russia. Maybe a portion of your ISA or pension savings at best. Which brings me to the second response of where to invest. The sensible solution to the investment quandary is to take a balanced approach and spread your money around different markets and countries. The fact is, no one knows which markets will do well this year, next year, or the year after. But we can tell from the past that stock market returns swing up and down. For example, the UK's FTSE All-Share Index has risen in 8 of the last 10 years, with gains between 5% and 30%. That 30% was the bounce back from the 2008 crash, when it lost a similar amount. It's the same story with share prices across the world. Or if you look at the various bond markets, or commodities, or property. All of these asset classes have had their ups and downs. The trick is to invest in a fund that spreads your money across a range of different investments like this. A balanced portfolio could have delivered nearly 8% growth a year in the past decade. It would have had negative years in 2008 and 2011, but the losses would have been less than if you'd been invested in just UK shares. Investing your money in a balanced way is not racy, but it could get you where you want to go financially. Who knows, it might even help you save for your next car.